Hello, everyone. If you can hear me, we're going to get started in just a moment. Can you all see me okay? I hope that everything's coming through all right. Um, Thank you for joining. Welcome. If you don't know me, my name is Will Snodgrass. I'm a certified financial planner and president of Matt25 Capital. I appreciate you joining us. There's been a lot happening in the markets lately, and understandably, many people are feeling uneasy. The goal today is real simple, and we're going to try and be brief, but really try and present the facts. We want to bring clarity to what's been happening, share what history tells us about moments like these, explain what this could mean going forward, and other related topics like that. As a reminder, if you have any specific questions, please email them to info@matt25capital.com. That's info@MATT, the number 2, the number 5, capital.com, and we will do our best to answer them during the webinar. So with that being said, let's jump right in. What's been going on in the markets? Well, we're going to start by taking kind of a broader look at what's been going on overall, not just where prices are today, but how far we've come over time and what it all means. Right now, there's absolutely no question the markets have been under pressure. As you can see from the chart, this is giving a little historical perspective, but if we look at just what's been happening just in the last few weeks and months, the S&P has been down, or was down, excuse me, about 17% year to date at its recent low. The NASDAQ had officially entered a bear market, down more than 20% from its recent high, and the Dow was off roughly 12% or so from its peak. The Russell, which typically tracks smaller stocks, was also in bear territory, down over 22%. And the VIX, often called the fear index, had spiked more than 100% in just a few days. That's pretty remarkable. But as the chart shows, some of the best two-day moves come within a month of the worst two-day moves, or in the case of the last week, within a matter of days. And if you look closely at the chart, this is going back to Black Monday in the 80s, for those of us who remember it, the global financial crisis or the Great Recession of '08, COVID, which I'm sure many of us do, and now most recently, the tariffs. But then came a very powerful reminder of how quickly things can shift. And as if that chart wasn't enough, this one probably will show it even more. On April 9th, President Trump announced a 90-day pause on most tariffs for 75 countries, while simultaneously raising tariffs on China to 125%. And the markets really responded quite dramatically. The Dow surged nearly 2,900 and change points, marking the largest one-day point gain in its history. The NASDAQ jumped 12%, its biggest percentage gain in 24 years. The S&P 500 climbed 9.5%, which was its best day in over 16 years. And the VIX, or the fear index as we call it, dropped more than 35% in a single day. That's pretty remarkable, especially given the week prior to that we were just coming off of. However, as of today, and the very day after that, April 10th, markets pulled back again. The S&P at one point fell close to 4.5%. The Dow was declined about 3.5%. The NASDAQ dropped about 5%, and the VIX spiked back up about 26%, reflecting ongoing investor anxiety and uncertainty. This whiplash really underscores an important lesson, and that is, or actually two lessons. The best and worst days often happen close to each other, and trying to time the market usually results in missing both. You may miss some of the worst days, but more than likely, you also will miss the good days. Case in point, if someone sold 2 days ago because they were tired of the volatility, they would have missed one of the best days in market history, certainly the best single day for the Dow Jones. So what's driving all this? I think everyone probably knows the answer to that, but the short answer is tariffs. And for those of you who don't know, a tariff is essentially a tax that a government places on goods imported from other countries. So for example, if a US company imports electronics from China and there's a 50% tariff, that company now pays 50% more in taxes on top of the original cost of these goods. And the idea behind them is to encourage consumers and businesses to buy domestic products by making foreign ones more expensive. But it can backfire. companies may pass those higher costs on to the consumers because they may not have a choice but to buy from international companies. That, of course, would lead to inflation or reduced spending and hiring to offset the impact. So what do tariffs mean in particular for our country right now in this instance? Well, it can mean a number of things. It can mean the increase of cost of goods. It can mean a disruption in supply chains, which is something we saw that happened a lot during the COVID era and for a number of years following that. It can hurt corporate profits. It can lower business investments, and it can lead to retaliation from other countries, as we're seeing. It may lead to bolstering production and demand for goods and services here in the US. That remains to be seen. But in the short term, what this really creates is uncertainty, and markets do not like uncertainty. There's been a few other key drivers revolving around tariffs and whatnot. So the US, if you recall or if you saw, they raised tariffs on Chinese goods by 125%. Those numbers seem to also be increasing, but we'll see what actually comes back. China retaliated by raising tariffs on US goods from 34 to 84%. Over 75 other countries had their reciprocal tariffs paused at least for 90 days and lowered to 10%. And the EU, Japan, South Korea, and others are preparing for countermeasures if no deal is reached. What this is really doing is it's causing quite a bit of confusion over trade policy. There really seems to be no clear path forward. And where the question is, are these policies a short-term tactic or a long-term shift? Ultimately, that uncertainty has been leading or fueling volatility. And then we couple that with Fed policy. So the Federal Reserve Bank, if you're not aware, really controls interest rates, among other things, in this country. And the bond market is really pricing in a strong likelihood of rate cuts starting as soon as next month, especially as tariff-driven uncertainty seems to grow. Wall Street also, and what I mean by Wall Street, I'm talking to corporate businesses and whatnot, is also slowing down. IPOs, mergers, and refinancing activity have definitely slowed dramatically because major institutions are taking a wait-and-see approach as to what may be around the corner. And I'm not meaning to paint all doom and gloom, we're just trying to give the facts here. So what else has been affected? We've been seeing tech stocks in particular see a lot of steep declines, especially because they're worried about their supply chain disruption and cost of their goods going or increasing pretty dramatically. Commodities such as copper declined, signaling growth concerns. Gold surged above $3,100, acting as both a safety hedge and a risk asset. Bond yields, the 10-year Treasury yield remains right now at around 4.4%, tightening financial conditions. So that's a bit of what we see, at least on the negative side, or at least in terms of what's presenting itself immediately. But let's take a step back, though, for a minute and look more at the macro and look at what history tells us about big market drops. So historically, the NASDAQ has averaged about 7% gains over the next 3 months after entering into a bear market, which, by the way, as of this recording, the S&P 500 was not in a bear market anymore. The NASDAQ was hovering around that level, but it's not in that. It wasn't in that level, at least for a good amount of yesterday, or all of yesterday and part of this morning. The Russell 2000 has gained 12% over 6 months following similar downturns, and spikes in the VIX, or the fear index, often precede future market growth. And if we look at the data on this chart here, especially at the 1 and 2 year mark, after the worst price moves, it definitely paints a different picture than what has been grabbing headlines in the last week or so. Not in one instance, at least going back until 1987, has the market been negative 1 and 2 years following those major 2-day sell-offs, with the average return over a 1-year period being 27%, and the average return over a 2-year period being over 40%. We like to put this into perspective for people because when you're in the midst of volatility, it's never fun, it's never enjoyable, it causes a lot of unease and unrest. But we also recognize that as quickly as things can sell off, they can just easily come back. And not that long ago, when we went through COVID, we saw the market actually enter a bear market, or a decline of 20% or more, in the quickest amount of time we've ever seen. Conversely, we also saw it recover in about as fast as we've ever seen it as well. And if you recall, by the end of 2020, the markets were positive by double digits. So one other thing we like to do, at least to put it into perspective for everybody, is even at the recent low point, which we hit just a few days ago, we had only retraced about 50% of the gains made between 2020 and 2025. That means for long-term investors, most of the bull market gains remain intact. And that is, of course, if they stayed invested. So for those of us who have had money invested since at least 2020 or before, we are still sitting on pretty comfortable gains, at least if your money was managed appropriately. So then here comes really the million-dollar question. Is a recession coming? And some analysts, including JP Morgan as early as this week, were projecting a 60% chance of a recession. Those numbers may have been revised, especially given what's happened in the last 24 to 48 hours. But markets had already priced in a 60 to 70% probability of that outcome. And what I think is important for people to understand, the market, the stock market in particular, is a forward-looking instrument. It is pricing in today what they expect to happen tomorrow. And that's important to note because if they are expecting a recession to possibly occur in the future, they're going to trade today based on that expectation, which is what we've seen the last few weeks. Conversely, when the news came out about President Trump putting a pause on tariffs on at least 75 countries, we saw the market jump up in an exuberant way because they're expecting that to be positive in the future. The other side, though, of analysts like JP Morgan and whatnot projecting a recession is that much of the bad news, like I just said, has already been reflected in prices we're seeing. And when markets find a bottom during recessions, rebounds can usually be pretty fast and dramatic. Just pull up a chart, if you can, of the last 36 hours in the markets, and you'll see exactly what I'm talking about. So let's look a little more granular and look at economic sentiment. So small business confidence has seen definitely a drop compared to number levels we've seen going back to 2022. Certain sectors such as health insurance and whatnot are definitely seeing a rise thanks to Medicare reimbursement boost, which is somewhat unrelated, but it is something we're noticing in the markets. Retailers like Walmart and others, Amazon possibly, or others like them, may see tighter margins from rising import costs. But despite all that volatility, investors continue to buy the dips. We've seen over $8 billion flow into the market in just the last week, not even counting yesterday. With yesterday being counted, I would imagine the numbers would be much, much higher. That $8 billion number was actually prior to yesterday. So all that to say, we covered a lot of data. What should an investor be doing right now? Well, one thing we can tell you for sure they should not be doing is they should not be panic selling. As this chart will show, timing the market is usually a fool's errand and will more often than not cost people dearly. This chart, if you can see it, shows the value if a person invested $10,000 in the S&P 500 from January 2023 till December of 2022. Had a person stayed invested the entire time, that $10,000 would be worth almost $65,000. Had they missed just the 10 best days of the market during that period, that return would have dropped to less than $30,000, less than half. And that's because 7 of the 10 best days took place in the bear markets. Now imagine they missed 20 of the best days. That number now drops their total return down to 17,000 and change. They missed the 30 best days, it's down to 11,000, and it goes on and on and on, so on and so forth. But you can understand the dramatic impact. If a person were to miss even just the 60 best days in a 19-year, almost 20-year span, their returns would have been 93% lower than had they just stayed invested. I think this really shows the importance of staying invested, not panic selling, because you never know when the best is going to come. You never know when the worst is going to come. If you sell at the bottom, you are taking the loss. You do not have an option or the option to recoup what you lost. And when you're trying to time the market, you don't have to be right once. You have to be right 2 times. You have to be right when you get out, and you have to be right when you get back in. It's hard enough to be right once when you're doing that, let alone twice. So an advice I would give to most people, don't panic sell. Another thing is stick to your plan if you have one. And if you don't have a plan, or you just have a portfolio but no clear vision of why it's invested the way it is or what it's if that's appropriate or not, it's time to get a plan in place. Another thing is stay diversified. You don't want all your eggs in one basket. And the reason for this, most people understand it from a high level, but you want to have assets in your portfolio that don't behave exactly the same so that when one goes down, the others should counterbalance that and be going up. To that point, a person should be considering rebalancing or possibly reallocating slightly. I'm not saying shift the percentages of stocks and bonds per se, but at least be looking for opportunities to rebalance. And another thing people should be focusing on is really looking at quality investments that have been through rough periods before. If you have a lot of speculative investments in your portfolio, those might feel this volatility more than, let's say, battle-tested, well-capitalized investments that have been through these kinds of periods prior. They just will be able to weather the storms perhaps a little bit better than some of those more speculative, volatile investments. And so one thing that we'll share is what we're doing here at the firm, Matt25 Capital, and what we've been talking to clients about. One thing is we are reviewing portfolios and risk exposure regularly with clients, not only looking at it from the portfolio perspective, but also looking at from the markets, what's happening, what we think may be occurring in the future, but also how it relates to our clients. Has their situation changed? Have their risk tolerances changed? Have their risk capacity changed? Or their risk necessity, as we like to coin? We're always trying to make sure that whatever it is we're doing is in lock and step with what our clients need and are comfortable with. And to that point, we're stress testing plans. We're looking at different scenarios, which we do well before the volatility strikes. In fact, our recommendations always take into consideration when a recession or period of volatility will emerge, not if. We always like to say that recessions will come. It's not a matter of if, but when and how severe. And so when we're putting plans together, we factor that in. We don't only look at the good years. We actually really focus on the bad years and make sure, is this plan still feasible, even if the worst were to come to fruition? We are currently rebalancing. We are focusing on strong fundamentals. We are relying on some of the experts within our team in our back office and who we have access to bring together the best minds to say, not only is what is happening right now and what does this mean for portfolios, but what does this mean for the future and how do we either capitalize on these opportunities or how do we avoid unnecessary risk? We're watching for smart long-term opportunities to that perspective or to that point. There are a lot of quality assets right now that are for sale, essentially, or at a discount. And what we've seen and learned is a lot of investors have a lot of dry powder or cash on the sidelines. And if they've been waiting for opportunities to perhaps put it to work or to buy assets at a discount price rather than at a premium, this has presented opportunities for those clients. And so we've been looking for those opportunities for them. And then we've really been trying to stay focused on strategy and not emotion. Warren Buffett famously said, when people are scared, you should be greedy. And when people are greedy, you should be scared. Unfortunately, for most people, the emotional side of it tends to be a little overwhelming at times. And what we really try to focus on is helping our clients to set any emotional biases or emotional strong feelings aside and say, is your plan still in place? Is it still viable? Are we still on track for what was important to you in the short, medium, and long term? And if the answer to those questions are yes, then it doesn't make sense to take a hatchet to the plan that was put in place. Perhaps a scalpel, perhaps it makes sense to make some fine-tune adjustments, but you don't necessarily want to throw the baby out with bathwater just because things are emotionally high. In fact, the argument that I would say to Warren Buffett's point is in moments like we've seen last week where people are panic selling like they shouldn't be or just overly scared of what may or may not be, those are the times people should be buying, frankly. And case in point, even though today is down a little bit, we are still up significantly from the gains that we saw yesterday. So the people that were putting cash to work in the days leading up to yesterday are probably sitting pretty well right now. So all that to say, before we wrap up, I really, especially for people that may be listening who don't work with us or maybe who haven't experienced this type of conversation before when it comes to planning and whatnot, my question to you all would be, are you hearing from your advisor right now? Are they helping you make sense of all of this. And because if they're not, I think you have to really ask yourself why. In moments like these, communication and clarity are absolutely essential. And if you're not hearing from somebody or the team of people who are overseeing your assets, number one, I think you should be. And I don't think it should require you to reach out. I think they should be reaching out to you. And number two, you should really be asking yourself, why wouldn't they be reaching out to me at a time like this? And so if you're feeling like you're navigating this alone, we're here to talk or answer any questions you may have. And then some of my closing thoughts. We can't control the headlines, but we can control how we respond to them. Moments like these really test our patience, but they also sharpen our priorities and bring them into focus. Our role as fiduciary advisors is to really guide people that work with us with strategy, not speculation. Our job is not to gamble. Our job is to really try to make things as crystal clear, people we work with, as we can, and build a strategy, factoring in as many different scenarios and factors as we can. So I hope that the information today provides some clarity and some guidance. I hope everyone walks away from here feeling a little more confident about not just what's happening, but perhaps what that means for them in particular. Again, as the disclosure said earlier, this is not investment advice. This is not a recommendation. And I don't know your situation, so I can't be given specific commentary over the webinar like this. These are more so just meant to be informational and high-level points that people should perhaps consider when evaluating their own circumstances in their portfolios. I appreciate everyone for joining us. Feel free to reach out if you have any questions. You can reach us directly at info@matt25capital.com. Obviously, our website is matt25capital.com. So if you have any questions, feel free to reach out. But